Hello guys, and glad to have you on board again today. It's been a little while since we recorded the daily updates, so I thought it was appropriate time to do one today. A lot has been happening since then, and basically we had these at least early stages of a possible speculative crash on these top 10 stocks, and we're just basically going to be talking about it today, trying to figure out if this is really the beginning of something bigger or just a tiny little pullback in which people will jump into and buy the dip once again, pushing us to higher valuations, and however this could eventually impact other stock indices or asset classes and stuff like that. So we're going to try making some kind of a global vision today, starting with this focus on the tech sector and what happened throughout the latest few trading sessions, and trying to frame that into a broader context, trying to figure out what we can take advantage of within the next few days in this very hesitating type of market. So still following on from the Nasdaq to Dow Jones arbitrage I've been talking about previously, we can definitely see that the smart money has been all about it actually. But of course, if you see it right now, you understand that this is way too late to get in. So it's definitely the point of me talking to you about it in the previous perspectives and previous podcasts. So it's definitely has been the game. So we'll see how mature is that game, what information that settles for the future, and how we can eventually prepare for the next move, because that's actually what we're dealing with in here. So I suggest we jump right into context right now. All right, so first things first, it's all about the tech sell-off. Is it going to go further, whatever? So you know this is the actual timing right now. This is the actual broader question the entire market operators are actually wondering. Tomorrow is going to be all about the ECB, of course. So this is a major game changer, specifically for Eurodollar. We'll see all about it because that can heavily impact the XY. A lot of people are buying into this thing. I still don't understand anything about it. But anyway, so we'll see all about that. We'll have a look, but not specifically at Eurodollar. We'll talk about USD JPY actually, but we'll talk about this one later on. Okay, so everything is surrounded, or everything is all around these tech sectors. Is it going to go further? Yes or no? Are we going to have a contagion effect to other asset classes and broader indices perspective? This is the answer we're going to try seeking today. So in terms of sentiment, of course, I hate to say that, but damn it, I was right. So we actually reversed very brutally. We've managed our way right up to 80 actually, or closer to it. And bang, here comes the shot right back to 50. So it's very brutal. Of course, lots of people weren't expecting it, but I totally was. So this is where I think the game is about to settle, because a lot of people tend to believe that there is a buy the dip situation right now. And I would say when I look at the sentiment right here, I totally disagree with that opportunity. Yes, we still have high low points and stuff like that, as you can see from the latest little dip we had in here. I would say, yes, still, that's a dip, of course. And if we build a new one in here below 60, then that will be a higher low point with higher high points and trend, whatever. This is not how sentiment works, actually. As the sentiment rapidly shifted, and you can see that we broke the trend line in the sentiment, I would tend to believe that, yes, something started, and I don't feel like it's going to end right now. We know that there is room to the downside down to levels below 50. We've gone above 70, which lead me to believe that we could eventually dip a toe below 30 in some specific cases, but not necessarily lasting there very long. So I think going 30 is a possibility, but does that mean we're going to go there in just a straight line and without ranging a bit? No, it's not how it works. So is it an appropriate time to go bearish right now? Definitely not. We'll see that we're dealing with supportive areas on multiple assets, and this is definitely not an appropriate time to get in. It's way too late. Once again, trading is all about anticipations. We've prepared for that shit for multiple days. It is not appropriate time to say, all right, the market is falling, I'm getting on this. This is not how it works, okay? You need to be there prior than the asset movement prices. And yeah, here we are. So it's just confirming that we've done a good job We made some gains. The question is, how much do we profit take if we do, or do we let it all open because there's much more to come? It's all about that, and that's the question we need to answer. So moving on, the intraday session yesterday after a 3-day weekend, not that fancy. A market breaking down with gapping structures and absolutely not managing its way up. Very limited amounts of volume, so I mean, that doesn't sound like a dip. I just want to say it out loud, that definitely doesn't. More than anything else, we had a V-shaped reverse on the previous days, and we managed to set ourselves to lower valuations. So we've made new weekly low points, tending to confirm what happened last week. We stood there for the entire day without building any supportive volume structure. So I would say this is not the type of structure in which we rebound out of. It's definitely not the case unless we do have an upside gap today, gapping above yesterday's low point and managing to bullish trend all day long and close at the high point. Still possible, but very less likely in my personal opinion, because I don't think the sentiment is ready for a V-shaped reverse. I think a 50 sentiment is something that we'll get closer to, all right, we're going to range a bit and see how the fuck we move later on. That's definitely more appropriate. Hesitations down the corner. Sentiment is now neutral. Don't be too much bearish. Don't be too much fucking bullish. That's what you need to understand. We're probably going to set ourselves in between the 60 to 40 area for pretty much quite some time. So get used to it. Embrace uncertainty, because you're definitely, I think, going to have to deal with within the next few days. Okay. Then, if you have a look at other broader assets, as you can see, is there any bearish fucking trend out there? So there's nothing, but just the VIX rising, and this is definitely something we've appropriately forecasted. The VIX might have a dip, and the VIX might rebound, and it might be violent, but that doesn't mean this is the end of the world. Could this still be a pullback? Yes, it can, but that doesn't mean we have to buy it and say, all right, this is one another of these bullish opportunities of a once-in-a-lifetime bear market. Fuck that. That's not appropriately how we deal with. Okay, yes, there's still a lot of money being printed out there, and people doesn't really know what to do with it. But that doesn't mean you need to risk take without any boundaries. That's not how it goes. But what matters in here is you having a look at whatever happens in the DAX, in the Nikkei, in the Euro stocks. Are these assets falling off the cliff? No, they're not. So if you're excessively bearish right now, you're definitely not in the mood. It's not how it goes. These markets have been ranging for several weeks right now, basically since mid-June. So they haven't made any progress, neither to the upside or to the downside, which in the same time, we've seen skyrocketing top 10 valuations. So there is a bubble on these assets, and we need to figure out if this is the beginning of something bigger, because a crashing market on these 10 stocks is very far from being over if that's the case. And the 29%, the 21% on Tesla yesterday, we can do a lot more than that. A lot more than that. So, I mean, yeah, I see a lot of people being stupidly reacting to this thing. I mean, was this somehow predictable? Fucking yes, it was. And I warned you about it several times in the past. We actually figured out the Nasdaq was in very dangerous zone just 24 hours prior to the sell-off. So yes, it is technically predictable into those cases, and we don't know for sure, but there are several odds pointing to some very dangerous moves, and they actually ended up triggering. So when things happen in a statistical way, why the fuck would you like to trade against them? I would say this was likely going to happen. We were prepared for this. Now we're into this, why the fuck would you reverse and say, all right, now it's going too fast, people are going to rebuy, whatever, just fuck that. You don't trade out of feelings, you trade out of what you think, but you need to make it rational. Okay, have a look at the 10-year bonds as well, or the 30-year bonds. Yes, they've been contracting recently. Are they falling off the cliff, rising and surging yields? No shit, Sherlock. Nothing like that showed up. Actually, even the 2-year note are rising right now. So, which means the yields are contracting in the short-term period, in the short-term end of the yield curve. So we know the Fed is planning something on the yield curve control. We just don't know yet what exactly it is going to be all about. So, coming from bond sectors, I don't see absolutely staggeringly bearish early trades. Coming from other futures market, no shit, Sherlock, nothing in here as well. So too much bearish right now, you must be in a wrong place and in a wrong pace. But still, assessing that what happened within the latest few sessions is nothing is totally stupid in here as well. We knew something would happen, it happened, so don't get it wrong and don't say, all right, this is just another pullback. Regarding dollar, of course, dollar has surged recently, but this trend is still intact to me. We're just pullbacking. So some people are trend following and they're willing to buy stocks because they feel they're in a trend, but they're willing to buy dollar. Jesus motherfucker, the dollar has been into a severe downtrend. And which trend are you actually following? The one you actually would like to see going one way or another, or both? If you follow one trend, you need to follow the other. That's how it goes. So, I mean, I don't understand these things. People doing two opposite things. All right. So if you disagree with one, you just don't do it, but you can do it on the opposite way. So I see some people supporting the dollar. Okay, what the fuck is going wrong? If you're supporting stocks in supporting the dollar, you're doing two opposite things in similar contexts. So what the fuck is wrong with you? If you disagree with one, you just don't trade it. You don't trade it the opposite way. So if you disagree with the dollar going down, you just stop selling it. You're not buying it for these reasons. Okay, that's very much what it is. If you're buying stocks because you think they're in an uptrend, then there's the exact same trend on the euro dollar. So something's wrong if you're playing both games in a different way. So yeah, I see a lot of inexperienced traders dealing with prices right now, so that definitely isn't a good sign. But all right, I mean, that's what it is. We need to deal with every market participant. I suggest we switch to context. Oh, sorry, so to technicals, so we get a clean vision of charts and risk management on them. All right, so today's topic is trying to figure out what the fuck is going on and what can we take advantage of in this type of market. So I could definitely tell that since mid-June, the one we've talked about, definitely all other assets have been flat. Yeah, definitely. I mean, just have a look at China. Basically, China is flat since April. Since the post-COVID, they just basically remained totally flat. So until then, the only thing that actually managed its way up is part of the German DAX, because this is where the most aggressive parts of Europe is, so it's totally understandable in a way. Kind of an arbitrage in here in which DAX has been overpriced versus the French index. That's a typical move of risk-taking into an arbitrage, okay? Definitely smart money arbitrage in here, but it wasn't necessarily that big. And obviously in here, the top 10 totally stupid bubble, and now the crash that starts to trigger. So the thing is that we're dealing with the previous high points into this top 10 stocks. So this is basically in here the top 6. I've been adding Tesla into this one. Yeah, as you can see, can a rebound structure happen out there? Can we actually do something? Is this the appropriate time to sell? Fuck no, this is not the appropriate time to sell. But is this an area for profit taking? We're going to try answering this question today. I don't think it is. Personally, I think that all we have to do in here is just looking at what happens. I'm waiting for mature ranges and to see how it goes, or just another fucking session, because that's totally possible. Don't forget that in these structures, people tend to say, all right, we're in support. Oh man, give me a second. Okay, sorry about that. So keep on following. This thing in here could just go wrong. I mean, if you think these things has to work their way down in a statistical way, then let me answer this question fairly simple in here. Then was this statistical? No, this is totally anti-statistical, which means we're just going to go as high as we possibly can until we break the toy. Just as you get it, okay? All those things have basically at some point nearly doubled their valuation in just a few months. Well, in the meantime, actually nothing actually changed. So it was very speculative, okay? And just so you actually get it, just look at where we're dealing in terms of prices in the French index or German DAX, okay? Just an inch lower, just breaking this support, which is pretty much just a few percentage points away, okay, would bring us down to this level, which is mid-June, okay? So if these indices are dealing with mid-June prices, what the fuck do you think is going to happen with the NASDAQ if it has to deal with mid-June prices? Falling off the fucking cliff. Yes, so is there more room to the downside? There is clearly a lot, and clearly a lot. So the question is not about can we go lower, it's just a question of how much probabilities do we have for asset prices to keep consolidating. And I would say that depends on whatever happens within the next few days. And I would even say that depends on what happens on other assets more than what happens in the US. Whatever is going to happen with the techs, I think there is way more downside potential. So buying right now, Jesus fuck. Of course, a lot of people were selling in this bull run stupidly. You've got lots of retails. I think, if my memory is right, it was 66% of net short positions into the NASDAQ just a few days ago. And now what do we see? 61% net buying. Jesus, man. Anytime this thing rises, people sell it. Anytime it goes down, people buy it. So it's just as stupid as it is. We've gone stupidly high, so we can go stupidly low, and there's plenty of guys to stop out in a way. So it's just, don't buy the dips just because you've been used to it. It might react today and it might not go down, but that doesn't mean it's going up. Okay, there are three ways in the market, in a way market can move. It can go up, it can go down, and it can just stay there. So I think that's the most appropriate structure right now, to just stay the fuck out there. There's no reason for us to go much higher. There's no reason for us to go much lower. It's just that we're expecting, once again, that someone else is going to come saving our asses. And that has become a very bad habit. Very, very bad habit. In a perspective that we say, all right, ECB is coming tomorrow, so they're going to save our asses. And if they don't, then it's going to be the Fed. Jesus, man. I mean, at some point you need to understand that they're going to have to wind down their things, as the actual real economy is starting to show some stability. For a little once in a while, it's pleasant. So as we see a little bit of stability, that doesn't mean we're going to have much more monetary support. They might be keeping the pace, but don't expect more to come. So what do you think is actually going to support this bubble? All of the retails are in. We might expect some downside momentum in terms of economic support, or monetary support. Yes, economy is catching up on this, which means we should range. And that seems fairly appropriate. We've been ranging for the entire summer. What about we just stay there a little longer? We're definitely dealing with some interesting areas in which, let's have a look at this, okay? If you take down the 10 stocks in here that created a bubble and pushed the S&P 500 to new historical highs, we're basically just like the Dow Jones, sitting into the 90% area. Oh, congratulations, that's exactly what the economy is doing. The economy is running at 90% of what it was, which means we are in a recession. 90% means less growth, or recession? I mean, there's no other way to say it, okay? But that's still a 90%, so that isn't bad, and we compensate that with monetary support. So can we actually sustain prices in there until things actually improve over the long term? Yes, we can. So does that mean everything has to fall off a cliff? Definitely not. And I don't believe this is actually going to come. What I think is about to come instead is this NASDAQ shit going to fall from very, very much harder perspective, because, oh shit, just have a look at that. That is definitely not good. I'm in a logarithmic scale. Okay, so when this thing falls, I mean, this is just the bare minimum. Going down 9,000 on the NASDAQ would just be like going back in time for probably just a year. Do we have radically changed the situation over a year? Of course, if you take down COVID, we're just 90% slower. We're just running 90% at what we did before. So just 1 year ago, we were far lower than that. Basically 30% drop of the market top. So is there a lot more to come? I tend to believe there is. It's just that at the current given time, people just want to avoid looking at the reality. They think it's just another pullback. That's still possible at that point. But look at this. When I see momentum going out of overbought cluster, this week isn't closed. Okay, so don't get me wrong. But if this week closes negative just like it is right now, this is not going to be great. It's definitely not. So it's save it right now, or it's going to be ugly. That's really what I think it is. It's all about this week. Yes, we know some things can happen, but people are expecting this to happen anyway. And I think it's very dangerous. It's a very, very much risky gamble out there to say, we're going to make a dip and we're going to build ourselves higher from there. I would say we've gone pretty high. We've gone pretty stupidly high. And if this thing terminates, it's not an appropriate time to try trend following these things. This is not a trend. This was a bubble, and when the bubble starts to see signs of popping, and we've been highlighting those probabilities recently, then what the fuck are you doing trying to follow this thing? It's fairly dangerous to do so. Is it still an appropriate timing to sell? Of course not. You don't sell supports, okay? So it's really appropriate for you to understand that the game settles over the week, and we're going to need to find some derivative reading to see what the fuck is going on. And I still tend to believe that this is the one that matters the most. And in a 4-hour chart, you can definitely see that we've totally validated the scenario we wanted. The smart money definitely played on this spread chart. But right now, I mean, yeah, limited downside potential, very likely probabilities to have exit patterns and stuff like that, totally suggesting probably 61% retracement could occur. And in that perspective, that means either Dow Jones falling or NASDAQ rebouncing. I don't know which one is going to come. All I know is that that depends on what other assets are going to be doing. If they actually actively go breaking some resistances, then the NASDAQ could retrace, not necessarily making new highs, okay? On the other cases, if other assets starts to break supports, which they can do very rapidly, if they just break one support, immediately the Dow Jones could fall off a cliff, and that doesn't mean the NASDAQ won't follow. That simply means that the Dow Jones might eventually lose more ground. And more importantly, that doesn't mean it's going to happen. As long as this thing goes down, can very well go way, a lot more down. Just have a look at the overall structure in here as well. Do you really think these are the kinds that needs to range before reversing? No, we can just go straight line in here as well. So don't get me wrong, we've piled up a lot of bad habits recently, and specifically mixing trends with bubbles. And people are calling this trend follow when it is actually bubble eventually about to pop. So don't buy the shit. That's absolutely stupid to try trend following a bubble. It might work, but it's also very dangerous in the process, okay? And more importantly, we've highlighted the risks that we don't know what liquidity is actually, if there's actually liquidity in those big assets, Tesla's, Apple's, just look at the volume. Tesla's volume yesterday isn't staggering and the value lost 21%. So if just an average or slightly higher than average volume can fuck up prices in such a manner, then, oh man, just have a look at this. Is this an historical volume that we've set it? No, just look at that. We've made that multiple times in the past without fucking 23 to 21% valuation. So that's really a concern about the underlying liquidity structures of those assets. Not great at all. We can see that just when a few people are asking out, there's no one buying in. Otherwise, we would have a staggering amount of volume to go lower. So it's just a few people going out in here and prices rapidly falling. So there is a serious question about liquidity. Can we go much further than that into those assets? Yes, I would say most of the buyers in here are still in and believing this thing is going to buy the dip and go higher. So if they're wrong, they're going to have to get the fuck out without no one wanting to buy the falling knife. So it's still a big question to me. Can we go lower? Yeah, we can go much lower because we don't actually know how much this thing's worth because we've gone freakingly high looking for price. And where's the value is the question you might wonder right now. Okay, that being said, I'm going to give you guys another trick because I think this is where the game is settling right now. Just have a look at USD/JPY. We've been concentrating, of course, in here as well. But until we actually started this flat structure, which was mid-June in here, okay, you can see that the USD/JPY has gone to the downside, okay, which means other assets have basically gone flat. But USD/JPY has a little bit of a downside arbitrage in here, still leading me to believe that something is down the corner. But most importantly, I wish you guys can just zoom out and have a look at how this asset behaved over the latest 3 years, because there's something really important to see out there. So you can see the USD/JPY has a very nasty tendency to trade some violent moves. So coronavirus is of course one of these, but this is not an exception. It just happened like every other asset. But I remember personally the 1st of January on 2019, which in basically I woke up and I was pretty lucky. I put in my profit taking targets on the account because I basically woke up with all my trades profit taken. Very nice gains for 1st of January. But I woke up most importantly with huge retracement. Basically the market just stood there for a very limited amount of time. So there was not an appropriate thing to say. We were dealing with some asset prices danger, but until then, it really has been a very violent move, an isolated move more than anything else. So I would say what happened in here in the yen, and it happened multiple times, just have a look at this, all right, lots of lower shadow candles that can happen in USD JPY. This is because of underlying market tension, okay? And basically I would say, I wouldn't be surprised if it happens once again. Like a final blow off or final fireworks for the Trump era. Like basically, I'm saying it out loud because once again, I don't like people commenting on stuff after they happen. So I'll give you my personal feeling about this. I suspect a flash crash is down the corner. I don't know why, and I can hardly explain that, but I see on one end, very limited access to liquidity on some very overweighted assets into stocks indices. That could cause these stock indices to fall rapidly. And we've also seen on the opposite end that there is quite a stability support that's building itself on the overall and global economy surrounding this 90% efficiency, and therefore this kind of cluster in which we're setting right now, and I think we're not necessarily needing to go much further away from. I still believe that in order to buy midterm to long term, some things to hold for multiple years, it still requires a little bit of a pullback. But I see the market in the end doesn't want to do this pullback because of monetary support. So we're kind of locked down into this area in which things do not deteriorate, actually. They do not improve either. They stand still, which is very uncomfortable for markets. Though we sit into these very tight ranges everywhere into Europe, China, and it's actually staggering that we've managed to do it for such a long period of time, but still. Well, I think something is going to come out of this. I doubt it's going to be bullish because that requires the stock bubble to keep on being inflated, and I doubt it's going to be. But in the same time, going stupidly bearish right now is probably not going to work. You can be bearish on some stocks, of course, because I think they have a much more downside potential, simply because they've gone so far from value that, all right. But still, those things still value something. I mean, Apple isn't a shitcoin, Microsoft either. So it's all about these things have gone so far that we don't necessarily know how much to pay for each stock. But when we'll find these numbers, and I think they're still pretty far from the current valuations, then there's no reason to go much lower. So it's all about these 10 stocks and how low can they go. After looking for how high, now the question is how low. And I think this can just explode into some kind of a beautiful fireworks finale in which we basically just create an absolute contagion, like every other asset classes is falling rapidly into just, I would say, one blow day. Like we're generally blowing everything off. Fucking every support, flash crashing structure. It happens immediately, very rapidly. People don't really understand what the fuck is going on. And actually just a few hours later, we're basically over. We've retraced 61% of the movement. We've made the dip. And I think we are going to settle ourselves back into this 90% area range, in which I think an actual positive outcome could come later after the election. So I suspect something is going to show up between right now and the election. I suspect this is going to look like a flash crash because once again, I think the USD JPY has a lot of supports to break, lots of trend lines. Okay, so all of this, I think we're going to fuck it all up. Like there is so much of a cluster out of 98, and I think we're going to dip a toe below it. I've always been clear, if you're dealing with the USD JPY to the downside, you need to have fucking profit taking targets at 95, because if we ever get there, we're probably not going to last there long. Okay. And I think we could do it in the absolutely stupid context in which I don't know, like Apple losing 60% valuation in a day, or not in a day, just in a few hours. But what that means is that everyone holding those stocks with leverage is fucked up. They have to get the fuck out. It's margin call after margin call and margin call and margin call. And that's a huge question. Can we actually have those flash crashes? Yes, we can. And the thing is that we do have securities into the stock market, but remember that those securities are meant to prevent robots from selling and selling and selling and selling. That are meant to prevent brokers from closing positions of their holding accounts because they're just in the red. So that's the thing. All of those leveraged stock owners, if prices fall, they're going to have to get out. And this is not a robot that will decide to sell. This is just people who have been going too over leveraged and just being fucked all in the same time. So I suspect that is the most appropriate way for us to go down. if we have to go down. And if everything just goes fine right by the election, then I suspect we must forget about selling. So we'll see all about it, but I mean, buying right now, no. Selling right now, no as well. So I'm definitely waiting for ranges to mature and to see what other assets, and specifically European indices, are doing within the next few trading sessions, because they, I think, are going to be the deciders. If they decide to go right up and break the ranges to the upside, then that might signal that, yeah, eventually there has been a buy the dip on the tech sector. I'm not going to follow this. I'm just going to trigger my stops at break even and move on to another trade. But until then, I'm just keeping those trade opens because I think there is a lot to come. I think it's going to be something irrational, and I suspect the flash crash is possibly down the corner, specifically on those 10 to 20 stocks that have been fairly overvalued. I doubt it's going to have a contagion effect that's going to last very long. Okay? And if that triggers, I think this contagion effect might be seen throughout the USD/JPY, and I think it's going to be something fairly rapid, just lasting a few hours. And as we get to some supportive valuations on Apple's, Microsoft, Amazon, whatever, some decent prices, I think smart money is definitely going to jump in. But at that point, all of the retail's leveraged people, they're going to be out and ruined. They're basically going to be margin called. So it's bye-bye, you've taken too much risks, and you're going to learn it the hard way. I think that's one of the many ways we can do this, though, but definitely I'm still bearish on the USD/JPY, looking at these areas. It's just that regarding at the past price action, I suspect if we go there, it's not going to last more than just a few hours. So that's the reason why flash crash is one of the options not saying is going to happen, but I bear in mind because I think it's probable. Okay, like a final flush on dollar, too many people buying the dollar in here as well. So I don't know. I don't think euro dollar is necessarily going to be a huge game changer, but yeah, there is room to go to 1.21, 22, and then we can pose. Okay, all of those things are very low liquid, so we can do a lot of shit in there, and that would nearly be a problem. Like pulling back to this area. Okay, this previous low point, I suspect, yeah, 121, 22, this is an area in which we can go. So if we just go out there while USD/JPY is falling off the cliff, yeah, there's inevitably a much broader downside movement to come in the US and the other stock indices. Probably just breaking some supports, but not going to the end of the world. So let me be clear. I think if there is such an opportunity breaking down in here, I think it's going to pull us right back to some very attractive entry prices. These areas I think can be bought. This is where we have long-term supports and stuff like that for the German DAX. So yeah, eventually falling off a cliff, something big. All right, this is big. This is a 10 to 20, this is a 13% drop. Can happen in just a few hours. Of course, we're going to have the circuit cuts and all of those things, and I suspect we can rapidly rise back in. Probably just a few hours later, we would eventually retrace up to 61% of it. So I don't know, but I already knew that something shitty would happen. We had the coronavirus, but I still have that feeling that it isn't over, that maybe eventually another cracking is down the corner. So eventually flash crash is one of these options that we can eventually use out there. Okay, but be aware that the CME circuit cuts and all of those things won't have any effect on this, but just to make it worse, because of course they're there to stop robots from overselling when there's a problem in their programations, which is not going to happen nowadays. Robots are much more advanced, but brokers and leverage positions on the retail traders basically will just have to trigger. And if they do, then circuit cuts, reopening, another circuit cut, and that's basically the shit. And the day right after, we just erase all of this and rise back from our ashes. So I'm waiting for opportunity. All right, that's what I'm going to be saying. Anyway, too much talking on this one, I'm sorry. Let's go right up to conclusion and try to make a quick summary of all these things. All right, so yeah, I'm sorry. It's way too long and I've been real talky, but I'm not going to cut that shit. So I want these things to be recorded at once. So anyway, quick recap in here of what matters out there. So I suspect you need to have a look at both what happens in other stock indices, and specifically I suspect the euro area is what seems to be the most rational to me. I'll eventually get you at the Nikkei in Japan if you want to see this, but I think having a look and putting your goals just into US stocks, I think is a big problem right now, still because of these waiting problems we've been talking about for multiple weeks, and the fact that we might have a trigger in the bubble in the US stock market, and specifically the top 10 stocks. So if the bubble triggers and pops regarding how heavyweight those assets are, can have serious impact on the stock indices. What matters is that we do see a lot of risk correlated assets that have been moving seriously recently, specifically the 30-year bonds, but they're still in the middle area of their range, which means they could go right down to the bottom without nearly triggering a panic like end of the world, the credit bubble is going to burst. We're just going to go like 1.5 or 2% yield for 30 years, and we can rapidly rebound out of there. So that would just be like a flashing thing that's saying, all right, people will over panic. I suspect it's going to happen all at once in a very concentrated manner. Remember what we've seen as well for the sentiment. I think the sentiment can go below 30, which is going to be very painful for people who has been over bullish for quite some time. So we can either do it real fast or do it slowly and steadily. But in the same times, that doesn't mean it's necessarily going to happen. So as long as we sit tight in the nearby area, as long as Euro stocks and stuff like that doesn't move away from their ranges, there's no reason to actually panic. So I would say look at derivatives reading. The VIX eventually could skyrocket into, like I said, if we go for a flash crash, we can have a 100 VIX. VIX at 100, everyone being totally fucked up into the derivative pricing, because basically a flash crash with liquidity is the worst case scenario. It's basically not just one robot selling because it has a fat finger, whatever, but it's just a lot of people being stopped out without liquidity, and that is a huge trouble. This can happen. It can happen on a few stocks, but may be sufficiently weighted to eventually trigger the circuit breakouts of a CME and all derivatives futures contracts, which could create a lot more jitter into the actual stock market itself. And I suspect all of this could somehow concentrate into a very painful thing. That's what I see as well in the way it has been priced over the latest few years in USD/JPY. So have a look at this one and bear this one in mind as well. Most importantly, don't be heavily leveraged into USD/JPY, but know that if you are trading this one, you need to put some fucking taking profits, because if this thing triggers and if you're away from home, might eventually just last a few hours, okay? And might be overnight, by the way. So yeah, I don't know. I'm just pretty concerned about all those things. Not willing to buy right now. We'll eventually make a second podcast because I'm ready to buy, but I'm ready to buy at much lower prices. So I think it requires preparations and all of those things. So we'll make a podcast all about it slightly later on. I think the second entry point of an economic cycle might be showing nearby, not necessarily immediately. But yeah, this early crashing structure on the NASDAQ, I doubt it's ever going to be reversing. I think it's just the beginning of something bigger. But until then, I'm not selling supports, okay? So I'm just waiting to see how prices will react out there. I'm definitely not profit taking. I'm willing to lose my intermediate gains if that's what's going to come. Until then, wait and see approach. Look at derivatives, risk pricing, VIX, USD/JPY, junk bonds, 30-year bonds. All of those things will give you the motive. As long as they do not reactivate, don't think about a V bottom. This is probably not going to be the case. I expect the range is going to come within the next few days. But as long as the bearish pressure maintains on the stocks and specifically the top 10, I suspect at some point all of this can concentrate into a heavily painful pattern. Okay, so if you're too exposed to the upside, what you need to do out of this is to cover the portfolio. I'm not saying short selling and try to make money out of this. What matters in here is you not being hurt. That's what matters. So don't try to be a gambler, short selling to make money. Just make sure you're safe enough. And if this thing doesn't happen, you're not going to lose money. This thing happens, you're going to be safe and sound. That's how it goes, okay? That's my advice for today. So just be aware for this thing. Not going to be a cataclysm, but just, I mean, eventually just a total blow-off situation, very short-term, and yeah, very painful for whoever's not covered. So cover your asses and normally everything's fine. And just wait for a few weeks. If nothing happens until the election, we can take this scenario down and eventually look at buying, even though expensive, we can still eventually look at buy stocks. We'll see all about it. Anyway, plenty of updates to come in the meantime. See you guys later.